Hey, good morning, options traders. And during one of the coaching calls, I got a good question from one of the traders asking about the advantages and disadvantages in selling calls against shares of stock. It's a good question. It comes up a lot, and so I thought maybe it would help everybody else in the group. So if you're selling calls against stock, it's actually a strategy called a covered call. And even within the covered calls, there are technically two different versions. First, if you buy shares and simultaneously sell calls, that's technically called a buy right. And that just means that you're buying the shares, selling the calls on the same ticket. They execute at the same time. However, if you sell calls against existing shares, meaning that they've been there for 5 minutes or 5 years, it doesn't matter, but they were already in your account, that's technically called an overwrite. But regardless, you're going to end up with long shares of stock and short calls. So let's say that you buy shares of stock for 100 and you sell the 105 call for 3. That is a covered call. So the question is, what are the advantages and disadvantages in doing this? Well, first, remember that whenever you're selling calls, you receive immediate cash into your account. Kind of the bird in the hand philosophy. Instead of having to need that stock price to rise to get an unrealized gain, you're getting cash immediately. Now, there's another technicality here that the full value of that cash isn't realized until expiration. And that means to fully get that benefit of that cash, you have to wait until expiration. But if that's a little foreign to you, that's a kind of a fuzzy concept, there's another video in this forum called Covered Call Curiosity, talking about this very concept, and it will go into more detail. And I'll leave a link for that video in the description below. But the fact is, you do get cash up front. However, when you do that, you've got the potential obligation to sell your shares for the strike. And I say it's the potential obligation because it's up to the person who bought the call to decide if they want to exercise it or not. See, it would be too good of a deal if you could buy shares for 100, sell the 105 call, get paid $3, and then also be guaranteed to sell your shares for 105. It just would be way too good of a deal. You could make all the money in the world in no time at all. The reason you're getting paid that money is because you're going to be holding those shares in your account. You're holding all of the downside risk. And yet the person who buys the call has the right to walk away. They also have the right to exercise. That's why they're paying you the money. So when you word it that way, traders say, well, why do it? Well, to answer that, we have to go back to our old friend here, the bell curve, which we've seen many times before. And the point here is that stock price changes follow a bell curve. So just understand that if the current stock price is 100, the center of this bell curve here sits right at the current stock price. So what this means by having this bell curve over the current stock price is that your best guess as to a future price is today's price. Kind of strange. If somebody says, what do you think tomorrow's stock price is going to be? If today's is 100, your best guess is 100. What's your best guess for next month? 100. Next year, 100. Now that probably doesn't sit too well with traders. They go, there's just no way. Stock prices typically make very big moves up or down. And that's true, but that's really a misinterpretation of what we mean by the best guess. So here's another example that I've used before. Let's go back to a coin flipping contest, let's say. You're going to flip a coin 100 times, and you've got to figure out how many heads are going to come up. Well, 50 is your best guess. But that doesn't mean you're going to be right the majority of the time. Instead, if you were to play this game thousands of times, this is what the distribution would look like, and right there in red, 8%. See how that bell curve lines up right there at 8%? That means you would be right 8% of the time, which means you'd be wrong 92% of the time. So much for it being your best guess. But still, it is your best guess because no other bar in this bell curve sits higher than 8%. So yes, today's stock price is your best guess as to any future stock price. So let's go take a look at a profit and loss diagram. If you just bought shares of stock at 100, this is your risk graph. You've got unlimited gains up and you're holding all of the downside risk. However, if you sell this 105 call for 3, you shift from the red to the blue. So you can see a couple of the effects. First, the blue curve is shifted to the left. And that just means you have a little bit of a downside hedge, and that's created from the cash that you bring into the account. So if you bought shares for $100 and you received $3, then your downside break even is 97. That just means if the stock closes at 97 at expiration, yeah, you lost 3 on the stock, but you gained 3 on the option, so you're even. If you had just held the shares of stock, you would be down 3%. So that's why this blue curve sits a little bit to the left. So that's one of the advantages. It's not a huge downside hedge, but it does give you a little bit of a downside hedge. However, the big thing that's obvious is that we cap all of the upside potential gains. So this is really the big question why traders go, why would you do it? Well, again, go back to your bell curve. If the stock is here at 100, where's that bell curve? Right there at 100. So notice there's a point where the red curve, the long shares of stock, and the blue curve cross, which is called a crossover point. And for this example, it would be at 108. So if the stock rises to 108, whether you bought the shares or did this covered call, you would be in exactly the same boat, have exactly the same profits. However, if the stock price continues higher, the person who sold the call never participates in that. But if you just held the shares of stock, you would. That's why this red line sits above the blue. You can continue making dollar for dollar as that stock price rises. So it's a trade-off. You're getting a little bit of, let's call it downside insurance, in exchange for letting go of some of the upside. But take a look at your bell curve. Look at where that crossover point occurs, right there, 108. And what that means is that you only have this probability right in here, this little wedge, for a probability for the stock to get above 108. It's unlikely for it to get above this crossover point. So you're just playing the odds that you're going to be better off with the cash than the potential unlimited gains. It's a pretty low probability thing. That's why you're writing the calls. Remember, it's far more likely for the stock to stay at its current price. So the covered call writer is taking for sure cash today in exchange for letting go of some of the upside and also receiving a little bit of a downside hedge. So to recap the advantages and disadvantages, when you are doing a covered call, first you receive cash up front. And what you're doing is you're playing the odds that the stock will sit still, or at least not rise too far. It gives you a little bit of a downside hedge. But for all of these advantages, the disadvantage is that you give up the potential upside. But again, that's probably not going to happen, at least the majority of the time. Now, as I've also talked about in many of the strategies videos, we can always work between extremes. So for instance, let's say that you bought 200 shares of stock. The red line shows your profit and loss diagram for long 200 shares. The blue curve shows your covered call. Long 200 shares, short 2 calls. It's exactly what we saw before. However, because you own 200 shares, we can now work in between these extremes. What if you just sold 1 call against your 200 shares? Now you're working on this green line. You're coming up between these extremes. And so your downside hedge is not going to be as big. Your upside gains still aren't going to be as big as the long stock, but they will be better than had you sold against the entire position. So by only doing what's called a partial write, meaning you're not writing against all of the shares you own, you still have the ability to make unlimited gains, and yet you still get cash up front and a small downside hedge. So as always, the benefit of understanding strategies is that it allows you to work between these extremes and to customize the risk-reward profiles that work best for you. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.